at retirement you need to purchase an annuity, and you have two choices, either a living annuity or a guaranteed annuity, or you can have a bit of both. In our previous video, we spoke about living annuities. If you missed it, please go back and watch so that you can get all the information on all the options available to you. This video, though, is dedicated to guaranteed annuities. First off, somewhat confusing, but these guaranteed annuities have many different names. Some call them life annuities or lifetime income, others call them fixed escalation or conventional annuities. But in essence, it's basically an insurance product. You give your retirement savings over to an insurance company and they guarantee, can you see the first name? To pay you an income for the rest of your life. Can you see the other name? No matter how long you live or what happens in the investment market, you're guaranteed your income. If you've historically been employed where you earned a salary every month, this is very similar. You don't need to worry or even think about what returns the market is giving. Your income is set and guaranteed. Just wait for it to arrive in your bank account every month. Another thing, and let this just settle in your mind for a while. This salary will be paid to you for the rest of your life. If you live to 120 years, well done. You're still receiving a salary. But now you're probably thinking about the other side. What if you die at 70? The insurance company keeps all the retirement savings you gave them. Yes and no. There are options available that ensure your money will continue being paid to your partner and beneficiaries after you die. We'll unpack those in more detail later in this video. For now though, think about this as a game of numbers. Someone is going to live to 120, someone else is going to reach 70. So what's actually happening is that your money is going into a pot, which is managed by the insurer. And those who die younger are subsidizing those who live longer. This introduces an important number to look out for when purchasing a guaranteed annuity: your starting income. Your starting income is just like your starting salary when you start a new job. Think about how you might compare salaries at different companies or negotiate your salary when you first start working. That's because it's the base that everything else works off. When you get future increases, they're calculated on that starting salary. Future increases with guaranteed annuities are dependent on the type of guaranteed annuity you purchase. Some have guaranteed increases, others are linked to market performance. We're going to give this topic of the different types of guaranteed annuities its own video later on. For this video, let's first ensure we understand the principle of what a guaranteed annuity is. Coming back to your starting income. The greater your capital, the higher your starting income will be. But there are other things that also influence your starting income, things that influence your life expectancy. The younger you are, the lower your starting income will be. Why? Because you'll likely need to be paid an income for longer than someone who takes out a guaranteed annuity at an older age. If you're female, sorry ladies, your starting income is also going to be lower because we generally live longer than men do. The guaranteed annuity provider might go even further than that. They might offer a service which is known as underwriting. It's a process where they ask you some questions. Does your family have a history of high cholesterol? Are you a smoker? Little things that, sad but true, influence your life expectancy. But while that's bad for your life expectancy, it's good for your starting income. It pushes that starting salary up. So be sure to ask about underwriting when purchasing a guaranteed annuity. Now, let's get chatting about the options you have with a guaranteed annuity to provide for your partner and beneficiaries after you die. For one, you can take out a guaranteed annuity that covers both you and your partner. It's called a joint life annuity. That means if you die at the age of 70, the money continues being paid out to your partner instead of you till their death. Furthermore, you can also have what's called a guarantee or guaranteed period. Some providers call it a minimum payment period. Let's say that you set that to 10 years. So, if you die and your partner dies within 10 years of buying this guaranteed annuity, the money continues to be paid to whoever you name as your beneficiary for the time remaining of those 10 years. You could also use part of the income you get from a guaranteed annuity to buy a life insurance policy. That'll pay money out to your beneficiaries when you die, no matter when that is. But now we're getting super technical. All I'm trying to say to you here is that if the idea of dying and leaving nothing behind worries you, there are ways to still allow for that. Just keep in mind that adding any of these additional benefits to your guaranteed annuity policy will likely reduce that starting income we spoke about earlier. Remember that the nice thing about a guaranteed annuity is that you just never need to worry. No matter what happens in the markets, no matter how long you live, you'll never be without an income. This is an important consideration because we must never underestimate the risk of getting dementia in old age, or our partner getting dementia. That limits our ability to make complex decisions. With a guaranteed annuity, you don't need to be making decisions around how much to withdraw or how to budget for that. You're in a retirement product that does that all for you. You'll always receive an income. You don't need to even think about it. Now that you understand what a guaranteed annuity is, next thing to consider is that there are different types of guaranteed annuities. That's what we'll be covering in the next video.